talk about bonds, and typically students struggle just with the terminology, so this is going to be a short video just discussing what a bond is and some of the details that goes along with a bond, and then we'll get into journal entries for our bonds in a separate video. Okay? Bonds are simply a way for a corporation to finance their debt. They're basically saying, we're going to give these bonds to people that are willing to buy, which would be our investors. Remember that New York Stock Exchange thing where everybody calls and says, okay, we're willing to buy this, 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 and they're taking all these orders. Basically, this company needs money, okay? So they're going to incur debt by issuing bonds, and investors are going to pay them for the bonds. Investors want the bonds because they're typically more secure than what a common stock would be, and they also receive interest payments on a regular basis. So if you're looking for a low investment risk, bonds are the way to go. Okay? So debt financing, the corporation is going to receive money. Okay, that's kind of a key thing here. One of the things that we'll be talking about whenever we do our journal entries on a separate video. So the corporation receives money. In exchange, they're incurring debts by saying, okay, now we owe these people this money back, plus interest. Okay, so bonds, it's going to become a bond payable, which is a liability, a long-term liability, meaning it's going to take longer than a year to pay off. Okay? Another term that we'll see whenever we're talking about bonds are premiums and discounts. Okay? When talking about premiums and discounts, we need to address the rates that are associated when we purchase a bond. If a bond was purchased at face value, that just means, let's say that the bond was a $1,000 bond. That's how much an investor is going to pay for that. It was issued at face value. They paid $1,000, they received a bond, and they're going to get paid interest on that $1,000 until the bond matures. We are going to have a coupon rate. It's going to be the rate that we're going to pay interest on the face value of the note. So I've kind of starred this. Coupon rate is what we pay interest off of. Whenever we do our journal entries, this is going to be very important to remember which one of these we're calculating the interest payment off of. The market rate simply says there are other bonds out there on the market, and investors are either paying higher or lower than that. So the market rate could be different than the coupon rate, or they could be the same. When the market rate equals the coupon rate, I'm going to use M standing for market and C standing for coupon. When the market equals the coupon rate, the bond is at face value. Okay? What happens when the market rate is higher than our coupon rate? That's where we introduce the terms premiums and discounts. If other bonds on the market are selling higher than what our coupon rate is, or what we are paying interest off of, we're going to be selling our bonds at a cheaper price, which means it's going to be a discount. Let's just go through that one more time because it's very important to distinguish between premium and discount. When the market rate, or what other bonds are selling for that are similar in nature to this industry, are set as a higher percentage, let's just say the market rate is 10%, and what we're paying on our bonds, remember the coupon rate is what we're paying the interest off of, what we're paying the interest off of is only 9%. Okay? The market is higher than our coupon rate, so we've got to sell it at less than face value. In that case, we're only going to sell the bond for $900 instead of $1,000. Okay? But we're still going to receive interest on the face value of the note, which is we're going to receive interest on the $1,000. Okay? So another scenario, the other scenario that we could have is when the market rate is less than the coupon rate. And we can just swap these roles here. when the market rate, let's say, is 9%, and our coupon rate, or what we're paying the interest on, is 10%. When the market, other bonds on the market are selling for less than what we're paying interest on our face value, they're going to be more interested in this, and they're going to be willing to pay a higher cost. So that's going to be our premium. So we've got bonds at face value, discount, and premium that we'll be talking about whenever we do our journal entries. Okay, interest, as we talked about early on in this video, that typically is paid on a semi-annual basis, which means twice a year. Okay, it could also be paid quarterly, which would be 4 times a year. But whenever we're talking about interest, let's just say the interest rate was the, let's just make it even and say it's 10%, the interest rate. So we're going to pay 5% interest rate every 6 months. Okay, so if we've got a $1,000 bond, we're going to pay $50 interest for the first 6 months, $50 interest for the second 6 months. That $100 equals the 10% that we promised per year, but it's just broken down into 2 separate sections.